we were just talking about the real estate side of things in the commercial, and I definitely understand the strategy behind it because you guys have so much capital to deploy. You work with subject matter experts, co-investing and so forth with individuals that are obviously that run point on it. My question is I was talking to a friend of mine, and a lot of these larger family offices, smaller family offices, and small retail, they like to invest with kind of smaller real estate syndicates. I'm
Yep.
curious, do you kind of do you find that there's a correlation? Because I was talking like private equity firm, they love the KKRs, they love the Black Rocks, they love all those bigger ones, but there's also smaller private equity plays that have huge decent sized funds, 100, 300, 400, $500 million kind of funds approach, very niche specific. Do
Yeah.
you, as a St. Louis trust, since you guys are allocating a lot of capital in those specific verticals, how do you guys think about it? Do you like to work with obviously the bigger players that have reputable background and so forth, that have a huge team, or do you like to work with the smaller kind of mid-sized funds? I like to say where they're 100 about $500 million funds. Do you find that there's a correlation behind it, or is it really relative?
Yeah, so our director of investments wrote on this a few months ago. This exact point on the size and of private investment managers, and what you get with the Carlyles and Apollos and KKRs is you get fine returns, but with rare exception, they're not going to be top quartile performers. And really, if you think about it, if you're at a large endowment or foundation or pension plan, the reason you go to firms like that is multifold. Number one, again, you're going to have decent returns. They're going to be fine. They do a great job, right? I'm not saying that KKR or Carlyle doesn't know what they're doing. They absolutely do. But if you're a big pension plan or a large endowment, you have a lot of money to deploy. Right. So if you decide to go to a smaller manager that's raising a few $100 million, you're going to have a lot of those, right? So, just not to have just, so many private managers, you're going to have to go to somebody that's going to accept a bigger check where you're not, 2/3 of the fund. And then if you think just about in terms of putting the money to work, if it's, KKR fund, whatever, and it's a 15 or $20 billion fund, what are they going to buy? Well, they're going to mainly buy bigger companies. Like, it doesn't make sense for them to go out and be buying a bunch of, 10 and $50 million, firms, right? So they're only going to be buying really big, usually very mature firms. So just the return expectations are just different. And what we tend to do, even though we are, have our clients are very wealthy, we're really, when we commit to private equity funds, we're often doing, $1 million commitments, right? To a private equity fund that is, $100 to $500 million is what they're raising. And it just changes the math. Because there's a lot of great companies that they can go out to buy for, $30 to $50 million, company that, strategically needs to be rolled up with somebody else or needs growth capital or what have you, that really has an exciting, ability to produce returns. And that's what we've tended to find is that it's easier. I shouldn't say easier. It is, you're more likely to be able to get into that top quartile of private equity managers when you're in the middle market. But it's different for different types of funds and firms. The same isn't necessarily true of venture capital, right? So if you can get in with like a Sequoia or Kleiner Perkins or Founders Fund or Andreessen Horowitz, it's different. So they are intentionally limiting the size of their funds because then they couldn't do what they do. And, not beyond, let's say, Andreessen Horowitz, their incredible skill and what they do to help their companies and direction and board seats and everything. But even beyond that, if you're a firm, and you need a Series B round, and you can get somebody like a Founders Fund or an Andreessen Horowitz, a Sequoia to invest in you, like that opens all sorts of doors. Like we'll have companies come into us, in terms of direct investing, and they'll say, oh yeah, we were funded by, Andreessen Horowitz. And right there, it's a good housekeeper seal of approval. It's like, when these investment managers come in and they say, Yale or Stanford or Washington University is an investor, right? it's huge. So with venture capital, it's more, if you can get into the brand names, the bigger firms, those are, a higher likely of success. We're more with, some buyout and growth capital in private equity. It tends to be more the middle market or smaller private equity firms. And Christian, to your point on real estate, yeah, there's a lot, real estate is even more local, right? There's definitely national trends, but being with investment managers that have a strong local presence where they're investing, I think it can be a really great strategy. And we've had some really great returns with some smaller, real estate managers. I don't think you need to be gargantuan. You don't need to be a Blackstone or something that is when it comes to real estate investing. So it really depends on the asset class.
And coming back to real estate as well, in regards to the structure, it's a very agnostic approach, but it's very obviously opportunistic as well, because obviously some industries, it may be very industrial focused, some may be more hospitality, commercial real estate, and some might be multifamily and so forth.